Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome back to the show. Today, we are in part 3 of our 360-degree full circle look at your portfolio. And we're going to wrap up these segments with the indexes. There has been so much that's happened this year in the indexes and the cross currents of the different indexes and what that means for your portfolio moving forward. I'm joined in the studio with Jason Riehl. Jason, welcome to the show.
Hey, Andrew, glad to be here.
Excellent. Well, let's dive right into it because this is one of these pivotal years where I look at the indexes on a daily basis and I say, wow, that doesn't make sense. And a couple days later, wow, that doesn't make sense. We've seen some aberrations that I want to point to that the listener can go do their own research. I'll give you one that's very, very recent because we're here wrapping up the third quarter of 2024. Did you know in the latter part of September, 1.3 billion shares traded on a single day in the Dow Jones? Now, for context, that's the Dow Jones indexed in the futures. For context, on average, it's about 200 million, 300 million. But a 4x volume on one single day, I like to refer to these things as a loud signal. Something's going on. The other thing that I'm noticing when I'm looking at the Dow Jones versus S&P versus the NASDAQ or versus the Russells is the Russells has had this incredible summer. In the month of July, all of a sudden, out of nowhere, you saw the Russells race up. These are all the small cap companies, about 10%. Yet none of the other indexes followed. And then it fell apart and came right back down. And now it's outperforming the other indexes. But that's very unusual activity. Typically, all the indexes like to follow each other. And we saw that between mid-July till mid-August. But yeah, about a 10% rise all on its own, crashing right back down a couple months later. And then the other thing I've been paying attention to is the NASDAQ specifically. And why? Because the NASDAQ has really led this entire boom. The last 5 to 10 years has been all about technology and now AI. So we're seeing all these different indexes figure themselves out, but moving in a very untraditional pattern. So Jason, I want to get your thoughts on this because we saw in August the VIX, which is the volatility index. Typically when the markets get crazy and volatile and there's a lot of selling or panicking, the VIX will spike. Usually it trades around 10 to 15. And we saw it go up to 60, which is never a good signal, but then it cooled right back down. So something is brewing here. We can feel it. We can see it in the charts. We don't know how it's all going to pan out. We got an election coming around the corner. What are your thoughts on the general indexes as you check out the charts?
Well, what you said in your opening there about cross currents, I think that's the best definition for this year. Now that we have some months behind us, it was tough to tell as it was happening. But you talk about different indexes doing different things, and I think it's positive in one way. There's a shift going on, which if you go back and listen to the past 2 episodes that we spoke about commodities and things like that, where we think money is headed, the indexes are kind of showing you that. NASDAQ has been leading this whole year and outside of the last 2 months, basically. I mean, now we have the S&P and the Dow have made new highs, and the NASDAQ has not made new highs yet. So usually in strong markets, the techs are leading. Strong markets, just going based on history. So are we seeing a market that's getting weaker, or are we seeing a market that's broadening because we have other stocks that weren't participating all year have started to participate in the last 2 months? A lot of market technicians like to see that as a positive. I think it is going to be positive in the long run. I think in the short term, in the short runs, let's say 3 to 6 months, I'm more concerned that the techs are lagging the Dow and the S&P. In the long run, I think it's probably positive that money's getting rotated into other economically sensitive companies or companies that have been, starved of capital over the last 5 or 8 years as things have gone on. So cross currents is the best way to describe it. And other areas are attracting money. So in the short term, the semiconductors have lagged the last month or two. Usually they're leading, and then we have the Dow making a new high without the NASDAQ. So that's just something to keep in mind. That could portend to some weakness coming.
And as a reminder, the Dow is composed of just 30 stocks. That's it. So the S&P 500, right? 500 stocks, the NASDAQ, we track the NASDAQ 100, and then the Russell's 2000. And then you have some broader indexes like the Wilshire 5000 that you can track. One thing that I'm going to encourage listeners to track is the equal weight S&P 500, because the S&P 500 over the last few years has been a little bit skewed because of the Magnificent Seven. And they have composed such a large percentage of the total market cap of all those companies that when they ran, the whole index went. When they fell, the whole index went. But to Jason's point, the NASDAQ led us into all of this, right? This last 10 years is very similar in so many ways to the 1990s as far as just the whole index went up 2, 3, 4 fold. Incredible run. And it was technology driven. And then between 2015 to 2025, as we wrap up this year, it's going to be the same thing. I mean, it's going to be a historic decade to look at to say, wow, the whole market, tripled in that time. The indexes literally tripled. So if we look back again, 2015, the NASDAQ 100 was at 4,300. Now it's at, 20,000. I mean, that's like a 5x, 4 to 5x on your money. And you didn't have to pick any stock. You could just spend in the general index. So with that said, the NASDAQ is the most important index to be looking at because it's the one that went up 5x, whereas the S&P, the Russell's lagged. I think they only went up 2x, and the S&P was like 2.8x, and the Dow is probably right around there, 2.5, 2.8x. So if the NASDAQ is the leader of this entire movement and it is not making new highs, that's the index I'm watching specifically. And that's why I'm raising cash to say, okay, if this is about to roll over, this is great news because this is going to be another buying opportunity. And I took advantage of this in 2022. I mentioned that in the last 2 episodes. If we rewind time and we think about when the Fed started aggressively moving up interest rates, the NASDAQ had quite a pullback in 2022. It hit a high, 16,000, almost 17,000. It pulled back all the way to 10,440, the NASDAQ 100, and that's that index. So that was that was like a, 30% move to the downside. And in June and October, I remember them specifically because I was traveling naturally, and all of a sudden you have, this golden opportunity. I bought whatever I possibly could with the cash that I had. And between then and now, it went from 10,000 to 20,000. So the whole index has doubled. And the stocks, I threw a couple names out there that I invested in, Netflix and Meta. They're great companies. We all know that, rarely at a discount. Those have gone up 3x and 5x respectively. So point being is you want to look at opportunities when there's a big roll off like this, a potential roll off, as a buying opportunity, but you need cash in order to do it. So Jason, what are your plans? Are you raising cash? Do you have your shopping list? As we've pointed out, the NASDAQ is vulnerable right now. If it cannot make a new high and it rolls over, you don't have an exact head and shoulders pattern going on, but that, left shoulder is not looking good right now.
Like I was saying, the fact that the S&P made a new high before the NASDAQ, and the NASDAQ is not leading now, gives me pause. I just wanted to step back. You mentioned, Andrew, about the equal weight S&P 500. There is an ETF out there, RSP, for the listeners at home if they want to follow the equal weight. And there's also the SPY, which is the S&P 500. Another thing that stood out in the last 2 months is is the RSP made a new high before the SPY did. So that can be looked at as some broadening, which is, good in the long run, but in the short run, the big tech companies aren't pulling their weight. They're not in the lead. The fast money's not there. So we wonder, could that be a signal that things are softening up or there could be a soft patch coming? I kind of see it that way. What's my game plan for the next quarter? Let's say the fourth quarter and the first quarter probably is to be lighter than I would be going into the elections and what the charts are telling me, and having, being prepared with a nice shopping list like you spoke about, Andrew. You should always have a list going for different reasons, but depending on your time frame, if we are having a pullback, then you should definitely have on your front of your mind, holding on to your cash that you have, not losing the cash you have, and being ready to take advantage of opportunities if that volatility does come back in the near future, which things are telling me. One last point as far as leaders and laggers, the semiconductors tend to lead, and when they lead, things are going well. In the last 2 months, they have not been leading. There's been a lot of like the broadening, if you want to call it, or other sectors are moving, but we want to see the semiconductors leading, and they have not been doing that either. Part of the reason probably why the NASDAQ could not make a new high with the rest of the market. So some signals. So yeah, be light on your feet now, be prepared, and a shopping list would be good for solid companies that are still making money and that just perception has changed for whatever reason. Then it gives you opportunities.
And it's really the story of two economies in our country. Because when you look at the Russell 2000, which is composed of the small caps, the small businesses of America, it's pretty alarming to see that since 2022, they have not made a new high. That means all those businesses in general are worth exactly what they were worth in 2021, and then the fallout in 2022, versus the NASDAQ, the tech companies, Magnificent Seven, the S&P 500, composed of the largest companies in the world. Those have all made 20% higher highs. So they've had record profits, record runs in their stock. And again, the small businesses have suffered. And the small businesses, the Russell's index specifically, was something I used to trade when I was a short-term trader. It was my favorite thing to trade as far as futures because it had a lot of volatility and swings, especially the opening and going into the close. And one of the things I discovered through a lot of research was that the big crash that came in 2008, if you look back at those charts in 2007, the Russell's was the indicator. It peaked first before anything else. And that was an organic boom, right? We had a lot of smaller companies doing really, really well, but it peaked in the summer of 2007. And then you had the rollover and it dumped essentially. And the rest of the indexes followed. But yeah, the Russell's was the first one. So I would keep a very, very close eye on two indexes, the NASDAQ and the Russell's. Because if the Russell's true peak was in 2021, and this has all been a hangover, and we're about to see some significant volatility and downside, it will show up in the Russell's first. And if the NASDAQ can't make those new highs, it's going to show up in the NASDAQ as well. So those are the two I'm fixated on. And again, doesn't mean I'm going to go buy stocks in them because I think tech has had such a big run. If you look historically at the decade of 2000 to 2010 and pick your favorite tech stocks, Microsoft, Oracle, Meta and Google weren't around then, but go back to some of the champions. I want you to imagine that you bought a tech stock right at that peak, 1999 or 2000. And then I want you to fast forward to 2010 and see what it was actually worth. They call it the lost decade. And there's a lesson to be learned there. During that decade, a lot of commodity stocks and other things were hot, but the tech stocks kind of went into a hiatus. And we've had such a run in tech that I would not be surprised if between the years 2025 and 35, unless the tech run keeps going, at some point it will go into its hiatus. And you'll be sitting around feeling like, great, I bought this stock. I got a good deal. It was a discount. But you can even run that same analogy as of 2001 or two. Let's say you bought the stock even after the pullback. Did it do anything for the next 8 or 10 years? You don't want to be trapped in that kind of value trap. So, Jason, as we wrap up, any other closing thoughts on the indexes and what you're seeing and where the markets are headed?
It's interesting you talk about the IWM. One thing that came to mind, how we had the nice move recently. I'm just wondering if that was an anticipation for the Fed rate cuts, because a lot of the small businesses depend on borrowing money to keep their services alive. And if the Fed's cutting rates and the IWM cannot get a bid, then something else that could be another inflection point or another something else to keep in mind. That there's bigger factors or bigger cycles in play, at least for the next few months, or 3 to 6 months. So they should be rocketing. I think they and since they haven't yet, like you mentioned, I'm just kind of piggybacking on what you said. It's just another data point that's odd.
Exactly. And we're seeing a cup and handle develop on that Russell monthly chart. So if it is like a multi-year cup and handle, that's great news. And if we make great new highs in the NASDAQ and the Russells, we have another leg, which is really exciting. And we'll see a lot of money being made in the Russells because of the rate cuts. But in the event that this Fed knows something we don't, and they are cutting those rates because there's a lot of unemployment and delinquencies, so on and so forth, watch out below. That's all I can say, because the NASDAQ and even the S&P have had such high PE ratios, all the stocks that compose those indexes. It's incredible. I mean, you're seeing stocks that traditionally would have 10, 15 PE ratios trading at 30, 40 times PE ratios. And that is not normal. And that's why I believe Warren Buffett is raising all the capital that he's got stored away, because he knows that just based on historical norms and averages, those PE ratios need to rein themselves back in. So it doesn't mean that the economy's faltered or these companies are struggling, but it's simply people aren't willing to pay what they were willing to pay these last few years from a PE ratio. And that's referred to as a PE collapse. Nothing wrong with the business, nothing broken with that company, but it's going to be a broken stock. So be on the lookout. Well, thank you for joining us for these 3 episodes. We do them from time to time with a 360 look at your portfolio and how we can guide you in the right direction. Remember, it's ultimately up to you what you do with your dollars, but be informed, be educated, and you will make great decisions. Have a blessed day, and we will catch you on the next episodes.